Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our econ show. Because of the Columbus Day, the EIA will be Thursday, and we're going to do the econ show today. So because of the holiday, we have a little bit less data. We still have about 76, 77 slides, so we're still going to have something to talk about. We'll just try to go through it a little bit faster, but I think that it's important to look at some of the pieces that have come out over that time period, because it's right in line with where we've been really discussing and how we think the world is going to continue to progress. So for those that have been following us, it shouldn't be surprising that the IMF reduced growth estimates. And yes, it will continue to get worse, and we continue to see that degrade based on the leading indicators we've been highlighting, based on all of the the decline in exports, especially in a lot of the Asian markets, and just the slowing demand and consumer activity in the developed world of both the US as well as Europe, but especially in the US, where we really saw that pivot that we called out last week, and it's continued to get worse, and we'll show some of that data in later segments. So segment one, we're going to talk about the IMF, some of the recent shifts. In the next segment, we're going to talk about how the volatility continues on the bond side, which is really driving those rates. And it's really on the back of the fact that the Fed can't pivot. And we've highlighted that constantly. We're going to continue to push that and highlight how that's the case. But we're going to go through some of those rates in segment two. Segment three, again, more red flags for the consumer, other things that are really starting to show that our pivot really started in September, but that acceleration should really be in October through year end. And then in Europe, we're going to go back to rates, because rates are pointing to way more pain. This is in the Europe as well as the UK. So we're just going to talk about the UK and how some of those issues are. And the BOJ, for those that haven't seen, for their 10-year hadn't traded for 4 days. They're now back above some of the pain, which we're going to talk about as well. And then in the Asian update, we're going to talk about Japan rates as well. But also, we want to look at what to expect for the Chinese Communist Congress, which is going to happen this weekend, and what are some of the big questions that we are looking at, and what some of the key things that are going to be answered as we progress through this period. So now when we turn to some of the activity, so we've been covering the Libya-Turkey situation on the EEZ. We actually have a whole show dedicated to it, and I'll put that in the comment section. And we're going to talk about it a bit more in the EIA show, because it's important in terms of where it is. And then we're going to talk a bit more about Russia tomorrow, when it looks at the cap and some of the areas that we've seen some increase in activity on both the Russian side and the Ukrainian side, and how that's going to continue to throw things into disarray for the most part when you look at the activity. But one of the big things that we want to talk about at this point is what's happening in Iran, because the anti-regime demonstrations are gaining more and more traction, and again, they have a rallying cry after the death of a woman who refused to put cover her face and hair. And again, it's something that we've seen happen before. They've continued to harass women. There's been video of them beating a pregnant woman who was in the protest. There's a lot of this anger that continues to reach, and they've tried to shut down the internet. They've tried to shut down a lot of their old ways of doing things to try to stem the tide. But if you remember, the U.S. took out one of their key entities, and that when you think about how they were reacting to protests, and by the elimination of the target, we were able to essentially take away the mastermind that was very good at getting and really putting down some of these protests. But now that we've seen some of these shifts, we've seen some of these movements, there is a lot of momentum behind them, and they will be addressed at some point, because again, this is, I think, a growing critical threat for the U.S. and the relationship with Iran. It's not a terrible situation, just because the people that are protesting are more capitalistic minded, more democratic in their mindsets. So again, it's just obviously there's still going to be pain. There's still going to be a lot of pressure. But now you've seen the petrochemical facilities. They've joined the protests. They've shut things down. There's rumors that it's spreading to the oil patch as well. And if you remember back in the 1979 revolution, when those people started to join the revolution or the protest, was when you started to see a real pivot. So I think that that's an important one to watch as we continue to go down this path, and we'll be following it and talking about it, especially as it relates to U.S. relations, Middle Eastern relations, and how that could impact current production as we see it in the energy patch. So then when you look at, can we afford another fiscal plunge, fiscal splurge? And the answer is obviously no. We've seen a huge amount of money come through, and the long-term look at government debt as a percentage of GDP across, the G7, emerging markets, and low-income countries, you get an idea of just how much debt has been, pushed into the market. And this is what we've been talking about when QE was the rallying cry. Everything was going through. This was everybody pushed everything out all at once. But now as rates are rising, as we get a lot of this pressure, well, the debt's getting more expensive. And every time you roll that debt, you're rolling it at a higher interest rate given the pressure on the rate side. So the ability to just dump more in there is very unlikely as we continue to see that pressure going forward. And the issues that we've seen, which is why, especially on the low income side and emerging market side, there's going to be a massive inability of getting that new stimulus into the market, that new quantitative easing, which is why we're not going to see the QE. But because we can't see QE, again, the fiscal side is just as hard, because the quantitative easing was keeping rates low, allowing the countries to issue debt at a cheap price because your central banks were buying it. And now if you just look at the BOE and what's happening in England, where you've had the biggest tax cut since 1972, but the BOE doing tightening, you've seen a huge spread increase, and we're going to talk more about that in segment 4. But again, it's why that we're hamstrung in terms of the amount of new spending that's going to come in, putting us in these dire straits, which is, and again, it's all because of the poor policies that we've had coming to this point, which again are things that we've highlighted as additional issues. Now, how fast have developed market central banks raised rates in the past 3 months, and you get an idea of how aggressive they gotten. But look at how aggressive they got on the cuts back in 2008, in December of 2008. And if you look at just where we never really tightened, and that's the key piece. When you look at 2008 onward, we never really had that tightening that we had back in like 2000, in June of 2002, in January of 2006. Like we never reconfigured the setup. So now you had another big easing, obviously in March of 2020. And here we are where now the overshoot is here because this is when the poor policy happened. When you look at from 2012 to 2020, that was where the policy issues were. That was where we should have been tightening and preparing for the future, because there is a business cycle, even though everyone likes to point to Davos in November of 2019, when everybody proclaimed the business cycle is dead. We figured it out. We're not going to have a downturn ever again. Well, that's tempting the economic gods, because they're like, oh, really? You've never had a downturn? Oh, you broke the cycle, huh? And here we are. And now, because of this poor policy all the way through, you've had this tightening, which as the tightening has continued, the leading indicators for the OECD continue to weaken, which again is a prerequisite for that move lower in the emerging markets, because as those leading indicators are coming down, consumers are slowing, businesses are slowing, people are actively not doing much, which again is driving things lower. And then you look at the fiscal policy conundrum, the cost of living complicates matters, because when you look at the stimulus, because the fiscal side is going to want to stimulate and support people, but you're going to also support inflation. While when you look at the fiscal and monetary policy mix, we're all in a position of either monetary tightening, fiscal loosening, which is creating this problem, or monetary tightening and fiscal tightening because of the inflation, because of where asset prices are. There's a tightening across the board, which is, again, hurting consumers in general, slowing down business activity and CapEx. But we'll in segments 2 and 3, we'll talk about the U.S. and the others in terms of Europe and Asia. But it's just as an aggregate, it's happening everywhere. And that's why when we talk about the IMF expectations, they've moved them down. And again, we're not just picking on the IMF because they're working with the data that they're doing, and they do great work of trying to put a number on it. And we get the ease of sitting here of pointing to that number and saying, well, they're wrong. It's like, okay, well, did we do the work? And yes, I do the work on some of them, but they have a lot of data behind it. And it's just when you look at where the trajectory is, where these policy mixes are, and what those leading indicators show, we're going to get much worse on the international global front. So when you look at the world economic projections, the world output, as you can see for 2021, was 6%. For 2022, it's expected to be at 3.2%. 2023 at 2.7%. And advanced economies, you can see moving to the downside. But one of the things is when you look at Europe, so the Euro area is still expected to have some healthy growth and actually positive growth in 23. And that's where we just don't see that capacity, especially if you look at Germany in terms of 2022 and where 2023 is. We see that going much lower in terms of what the trajectory is on price, on natural gas availability, on industrial activity, economics. And there's a lot of some of those downswings that we think are going to continue to reverberate. But you get an idea on how there's already an expectation that 23 is going to be worse than 22. But it's still positive. And that's where, if you look at everything we've been talking about, a lot of things have gone negative, especially the leading indicators, which is already showing the pain that we're going to get in Q1. And we still haven't, all of this is happening, and we haven't even had the consumer really crack yet. And again, the consumer's gotten weak, don't get me wrong. You're starting to see the real estate side rolling over, but we really haven't seen that big pivot down. And that's when you get that in the developed market and how that reverberates into the emerging world. That's that next leg down that we're talking about. That there's only so much they can plan. So that's where we do expect another write down on a lot of these projections. Emerging markets and developed economies, again, overstated in general, as we've been talking about on the China side. If you look at 2023, they have China reaccelerating, and we just don't see that. And we're based on everything that we're seeing in general, it's that it's going to either go flat or at least go much, much lower, especially when you consider that China itself is announcing these types of GDP numbers. And if they're saying it's typically probably much worse than what it actually is on the ground, which we'll talk about more in the last segment. And here's some of the key reasons why. Because food prices and natural gas prices, they're not going lower, and you're seeing a lot of that stickiness here, and that's impacting price, that's impacting inflation. And yes, you'll get some base effect, you'll get some of that coming through, but there's still a huge amount of pressure going forward, which I think needs to be considered when you're looking at, well, how are food prices? And that's going to be a huge impact on the emerging market side, especially as we had Indian inflation reaccelerating a bit. We still haven't, when you look at PPI, that leading edge of where inflation is for the consumer is reaccelerating again across the world, which is pointing to more pressure, especially on the natural gas side, the food side. And here's one of the key reasons. So the WASDE came out while we were speaking. We'll talk to it a bit afterwards, and especially on the FSC show as we provide that last roundup. But when you look at U.S. soybean ending stocks, you get an idea of where the 5-year range is and where we are right now, and we're not in a comfortable spot. And that's the biggest issue around the world when you look at the availability of food, how much is available, and you can see that continues to move lower. And it's not, when you consider obviously the food side with the U.S. being a huge exporter into the world, as we shrink, but there's also those other pieces of, well, where is Europe getting their natural gas? Well, there's no restocking without LNG. So LNG is a huge, important piece to the solution when you look at how much Russian natural gas has dropped off and how LNG and Norway have been able to try to step in and replace some of that, but it just increases cost, and it hurts the volume that can be pulled in quickly, because obviously piped gas is the cheapest. But also, if we get a huge a downdraft in terms of a polar vortex or some other issue, the availability is going to be a massive problem, because there aren't LNG cargoes available at this time if you're trying to plan things out. So that's going to create even more problems within the European continent in terms of availability and price, which is why when you look at that broad slowdown, and again, they're coming out and saying there's a lot of uncertainty. So it's not like they're saying that if you look at the adverse scenario, which they're modeling, they're like, look, this gets ugly. And that's the unknown, because they're still trying to show, look, this is the data we have. These are some of the projections. This is our base case. But when you look at the way we're looking at the leading indicators, we think that adverse scenario is much closer to the base case than that global growth rate, as you're starting to see kind of things flatten out. It's just, you can see that there is that downside, there is that move lower, and the 2023 real GDP growth, you can see just in terms of where it was in October, where it was in July, where it is in October, and how you're getting that slow move move back. But the euro area saw the biggest shock down. And I think as you see the consumer in the US shrink, you're going to get another pivot. And as you get those two areas pivoting, that's going to, again, draw down a lot of those emerging markets, which is why when you look at the persistent price pressure, that again puts more of an issue on top of the emerging world, because I still think that there is this hesitancy, or this view that the US is going to the US Fed is going to pivot and the central bank is going to change things. And as that doesn't come to fruition, which is again our base case, which we're going to talk about in the next segment, then you're going to get even more pressure on countries and their ability to borrow, and how they're going to try to hoard dollars to protect against inflation. And as we talked about last week, the strong dollar is our base case. Like, we're going to be here for a while, and that's going to put maximum pain and again shrink and really hinder the activity at the emerging market level. And even though you've had these issues, the UN food and agriculture price have come down a bit. And when you look at it on a rate of change, you can see a big rate of change. But look at, even with that big drop, you're still at historic highs. So yes, we've come down, but we're still at this elevated level. And now when you go forward and you look at how plantings are already getting impacted because of drought, because of precipitation and moisture availability in the soil, and again, that's where we expected things to normalize a bit, but again, see some of that flatlining. And looking at it a little bit differently, you can see that there's been the 6 consecutive monthly declines, but now when you look at the month-over-month change, you get an idea that you had that big drop, but it's the month-over-month is slowing. And yes, it rolled over, it's there, but this is that gradual piece that we're seeing and some of that support for continued elevated prices. And then when you look at, again, some of those key leading indicators, there's a lot of capacity unconstrained. There's a lot of availability. Global supply chain pressure index is coming down because you continue to see a lot of slack coming back into the shipping market, coming back into the trucking market, which is again, that leading edge of where trade is and how trade continues to slow. Then when you look at the short-term forecast, you kind of get an idea of that there's the mix of nitrogen, potash, and phosphate when you look at prices over the next 6 months. So this is where you've had prices fall, and again, kind of factoring in all of these UN prices, factoring in the availability of ships, because some of this is moving on boats, where the availability on cost is on the rate side, but the actual cost of making it has gone up because of natural gas, because of mining, diesel. And then you've also had a lot of shutdowns of fertilizer plants, which is cutting supply. Again, impacting where those prices are. So sure, they came down, but now you're starting to see them settle out at very elevated prices versus historics, which is going to put a floor in some of those pricing. And then here, when you look at trucking freight volumes out of the most important port city are now trending below 2019 levels. So when you look at LA, we are now below what was normal and remember, 2019 was a weak year. So we're below 2019, which was already a weak year going into going into December. As you can see, that drop in 2019, that again was why we were so bearish heading into the 2020, January of 2020. We were already bearish because of that, and now the new number is below where we were already getting bearish in a normal market, again, showing the problems that we're seeing. And then when you take that and you look at, again, factoring all of this in and then back to the IMF data, well, the real GDP versus pre-COVID trend, you can see that US GDP growth is slowing. Eurozone recession is in play. And that is that leading indicator that's going to drag down a lot of these pieces. So when you look at one number matters above all others in this week's IMF World Outlook, the IMF doesn't project negative Eurozone growth in 23. It suggests there's substantial downside to their global growth forecast, but a lot of individuals, especially the IIF, is forecasting a negative 2.4% Eurozone recession in 23. And that, again, is pushing more pressure when you look at Germany, where yields of mortgage-backed securities have risen to the highest level since 2011, which was the kickoff to the European sovereign debt crisis and debt crisis. Consumers have to pay almost 4% for a 10-year mortgage loan, 4 times as much as the start of the year. And the volume of mortgage loans has obviously slumped 16% year on year because of that. Then when you turn to China's growth in the first half of 22 was so weak that it leaves annual average growth for this year at just 0.5% if you assume zero GDP growth in Q3 and Q4. Only 3 countries have a worse GDP growth, which is Russia, Sri Lanka, and Ukraine, to give you an idea of how some of that pressure really starts to factor in general. So that's what we have for you on the overall global market. And now the next segment, we're going to go deeper into the US and some of that volatility and those rates that we've been discussing so far on a global basis.